There's really no reason why gold will not go up unless Elon Musk starts mining on asteroids in the near term. That's the only way I would get bearish on gold, because we have to remember that you have debt in the political system, right? The U.S. debt just keeps going up. There's not one candidate for president that's even talking about the chart of gold. I'm using a logarithmic chart again, back to the 1980 high. We connect that to the 2007 bull market high and look at what we just tagged on gold. So for me, as a shorter term trade, I'm short gold here for a pullback to 2,500, at which point I plan to flip it over as my mid to long term remains bullish to 3,000 being hit next year in 2025. So 3,000 target next year.
Commodity analysts who make long-term forecasts believe that the price of gold will generally keep rising in the next few decades as the demand for the precious metal increases. The price of gold has doubled since 2019, with a notable acceleration in its increase in 2023. This rise is unexpected, given that rising real interest rates, a slowdown in inflation, and a strong dollar should have dragged the price down. Expert trader Gareth Soloway dives deep into the current state of the gold market. Based on data, Gareth Soloway expresses that if the economy declines and sell-offs occur, the capital will likely shift away from tech stocks and flow into more defensive areas like bonds and gold. Despite his long-term bullish outlook, Soloway expresses his current short-term bearish stance, while after the correction, gold can reach $3,000 by 2025. He explains that his analysis connects the 1980 high with the 2007 bull market, showing a key level being tagged. Soloway remains bullish in the long term. Moderating but still significant central bank purchases on the London OTC market could drive about two-thirds of the expected rise of the gold price to $2,900 per ounce in early 2025. The bank said. Regarding gold's outlook, Gareth Soloway predicts it will rise by mid to late 2025 due to increasing U.S. debt and government spending. He believes a potential recession will drive even more spending, further boosting gold's value. Interestingly, a historically strong correlation exists between U.S. debt and gold prices. Conclusive evidence shows that the U.S. national debt ballooned from $5 trillion to $35 trillion during this period. Gold prices have risen by 10 times since 2000. That's a whopping gain of over 826% since the beginning of the century. If history repeats itself, gold prices could reach $5,000 an ounce when U.S. debt hits the $70 trillion mark. Now, we present the clips of Gareth Soloway's insights from his recent interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates.
So I think as a safety hedge, you have to be bullish on gold. You have to be bullish on bonds. You have to basically look for these places. Like when you have utilities doing well and defensive names, if the economy starts to tank and we do see any sort of sell-offs in the Walmarts, the money is not going to necessarily choose tech stocks. It's going to still have to be invested, but likely heading to other areas like bonds and gold. I'm short gold right now. Now, please understand, everyone watching at home, I was a bull at the start of the year when we were at 2,000 on your show. In fact, I said, hey guys, my target is $2,530. We've gotten there and even gone past it per the analysis. And that was a beautiful trade. Like you said, I was called crazy. People said, hey, gold is over with. No one wants to be in gold anymore. I love buying things when people say that. So check this out. We have the chart of gold. I'm using a logarithmic chart again. So we look at the logarithmic. We look back to the 1980 high. We connect that to the 2007 bull market high and look at what we just tagged on gold. So for me, as a shorter term trade, I'm short gold here for a pullback to 2,500, at which point I plan to flip it over as my mid to long term remains bullish to 3,000 being hit next year in 2025. So 3,000 target next year, but in the short term, I'm expecting a pullback. And we've actually started to see it. If we flip over to our daily chart, you can see right into that level. Look at that. Beautiful how the charts just work their magic. We're starting to see a pullback. Here's your target zone right here. This is around 2,500. We can see how this was kind of a shelf right here. Then it broke out. We should retrace right back into that level before the next bull move comes in. I don't think it'll be until 2025, probably mid to late 2025. But yeah, there's really no reason why gold will not go up unless Elon Musk starts mining on asteroids in the near term. That's the only way I would get bearish on gold, because we have to remember that you have debt in the political system, right? The U.S. debt just keeps going up. There's not one candidate for president that's even talking about reducing spending. And remember, remember, when you have a great economy, that's when governments are supposed to pay down the debt because they're bringing in more tax revenue. Instead, our government really for a long time now has just been spending, spending, spending. The problem is if we go into a recession like I think, they're going to need to spend even more to stimulate us out of that recession. I don't even know if it's going to be possible, but you can't go into fiscal austerity when you have a recession. I mean, that's just going to make us go into a depression. And so that debt is going to keep going up, and that's going to make gold a valuable asset to diversify away.
During the interview, Gareth Soloway expresses skepticism about market reliability, predicting a slow economic decline. He highlights historical patterns suggesting a recession may occur by early 2025 due to an uninverted yield curve and warns that aggressive Fed cuts could trigger stagflation despite recent drops in inflation. Over the course of the 21st century, the global economy has confronted unique challenges, such as the financial crisis of 2007 to 2009 and the onset of the pandemic in 2020. Many analysts feared a recession would result from the Fed's recent interest rate hikes, which spiked bond yields across the economy. Yet the economy has managed to grow consistently throughout this period of higher interest rates. Based on historical stagflation, Soloway expresses concern that rising U.S. debt may hinder the Federal Reserve's ability to lower interest rates effectively. He predicts that while rates might decrease, inflation could rise, complicating economic recovery. Let's get back to the interview.
Just a couple of days ago, the markets were favoring via the Fed watch tool another 50 basis point cut in November. That would be 100 basis points in two consecutive meetings. Yet somehow the spin being put out there in the media is hey, this is actually great because it means there's no chance of recession. Guys, the Fed is not crazy. They are not cutting that much because everything is okay. If they thought it was going to be a perfect landing, they would do 25 basis points a couple times, then wait a little bit, make sure inflation's not roaring back. They are concerned. Now, the narrative is being spun away from that. Don't get fooled by that spin. I also agree. I think it's very unreliable. I think that for the most part, the markets cue off of what the Fed says, and then they obviously extrapolate out. But to me, you're looking at an economy that is going to slowly weaken, right? If we look at the various metrics here, we have the yield curve has now uninverted. If you look at the yield curve, what happens? It uninverts 3 to 6 months later. We have a recession, and that's been historically the norm. Pretty much even going into COVID, it was briefly inverted just before COVID hit. And so we have to say that, okay, by the end of this year to the first quarter of 2025, that's when your recession hits if you go by the data. And it's very important to go by the data. In addition, if we take a look here, and if I could show my chart, I want to show you the 10-year yield. Look at what we have on this. It's fantastic. So we have gone to a point where we are now coming down on the 10-year, and I have major technical support. Look at this high here, right through these lows, this upsloping trend line. These are merging around 3 to 3.25%. So for me, I'm looking at this is where the Fed funds levels are going to be, where we're going to come down to on interest rates. Now, that kind of puts it in the range, but still, the key to understand here is that we're likely going to see a recession. The Fed is going to want to cut more, but I'm fearful that if they cut too much, it's going to kickstart the inflation gauge again. And I am worried about stagflation. I do think stagflation is a very possible outcome here, not in the near term. No one's going to talk about it for a little while here because we've seen the numbers come down on inflation. PCE came down, CPIs come down. But I do worry that the Fed being so aggressive on these cuts, you're going to see inflation start to move up, but you're not going to see the economic growth that you're hoping to get. Yeah, so number one, we have to look back to the 70s when this happened, right? So in the 70s, this was the last time you saw this kind of stagflation type of focus where we did see inflation moving up even when the economy was slowing. And my fear is this, is that you're getting to a point where the debt is going to start to matter. So you have 33 trillion, 30, whatever it is, $1 trillion in debt now for the US government. The Fed at some point when we get in a recession, they're going to start to make money even easier. And I do worry that these implications are going to force inflation to uptick just a little bit, which is going to basically hogtie the Federal Reserve from continuing to lower rates back to where everyone's hoping. And, mortgage players and interest rates, the thought process is, hey, they could go back to where COVID was, at zero or just around those areas. I don't see that happening. And I do worry that that's going to be the outcome here. We're going to see interest rates coming down, but stopping because inflation begins to kick up again. And then you have a weak economy that can't be stimulated out because inflation is starting to push up.
As we enter October, gold seems poised for further gains, with forecasts ranging from $2,600 to $2,800 per ounce. This optimistic outlook builds on gold's impressive climb since the start of the year. How do you think the Federal Reserve's decisions and economic growth will impact gold prices in the near term? Drop your thoughts in the comment section below. If you find this video informative, don't forget to support our channel and turn on notifications to stay informed about our latest videos. See you in the next video.